Hello, this is Nathan. Welcome back to Independence Money. Today's topic is taxation on mutual funds and some tips and tricks you need to know about. A recent survey said 45% of Americans own mutual funds. And for those of that own them in an after-tax or a taxable account, it's important for you to understand it's not what you make, it's what you keep. Now, this isn't individual investment advice. I'm a certified tax specialist, and I'm just giving you some pointers on how this works. Now, when it comes to investments, most people understand that it's a factor of when you purchased an investment, when you sold it, whether it was for a gain or a loss, and whether that holding time period was longer or shorter than a year. Short term is treated differently and typically less advantageous than long term. So that's an important thing to remember. However, when it comes to owning mutual funds in a taxable account, that really doesn't apply to when you bought the fund, how long you've held the fund, and when you sold the fund. It applies to what the mutual fund owns, the individual assets inside of the funds. So to make things simple, let's give an example. Let's say on January 1st, the mutual fund investor bought XYZ stock at $100. You bought into the mutual fund on December 1st, and because you're curious, you looked up and found out that that top holding, XYZ company, was currently trading at $120. Now, let's say the following day, the fund sold out of XYZ stock at $119. You may be thinking, well, that's okay. My share was at 120. They sold at 119. That's a $1 write-off. I don't owe taxes, right? That's incorrect. You pay taxes on the mutual funds time period. So in this case, you would be passed on your share of taxable capital gains, which are short-term, from the difference of 100 to 119. And short-term is taxed at your higher tax bracket. This is totally unfair, and there's nothing you can do about it. One thing you might be aware of is to look up on Morningstar or any of the financial websites using the ticker, the 5-digit ticker of your mutual fund, and look at what's called turnover ratio. Turnover ratio has to do with what percentage of the portfolio the manager sells and rebuys something else within a given year. So an example of 50% means if the manager bought 100 stocks at the first of the year, they're going to hold less than 50% of them throughout the end of the year. Some mutual funds have turnover ratio north of 100%, which means they're hardly holding anything longer than a year. As I aforementioned, any short-term gains are taxed at your higher tax bracket than long-term items that are owned over a year. Furthermore, you have no control over this. I like to describe mutual funds like riding public transportation. If you've ever been on a bus going anywhere, you realize that the bus pulls over each and every stop where somebody wants to get on or get off, obviously slows down a direct route as if you were driving your own vehicle. That means that if other investors get scared during a down market or recession, and they call up the mutual fund manager and say, hey, I want a redemption to cash, even if the manager likes the stocks and wants to hold them long-term, they have to sell at a percentage of those stocks to meet those redemptions. So that's called kind of the herd mentality. Your performance is affected by other people that own the fund. And even if you're disciplined and they're not, you get the ramifications of, unfortunately, their decisions. Another thing to note is there's a difference between ordinary dividends and qualified dividends. Ordinary dividends are taxed like short-term gains are, meaning at the higher end of your tax bracket. Let's say you're in the 22% bracket. Mutual fund manager buys and sells a stock in 11 months. You pay a short-term capital gain, 22%. Let's say that stock paid an ordinary dividend during that time period. Again, 22%. To give you a difference of the tax code, let's look at qualified dividends. Those typically are domestic-based equities. They are taxed at the same rate as long-term gains, owning something over a year. If you're in the 15% bracket, those gains, long-term gains, those qualified dividends could actually drop to zero, meaning you pay no tax on that whatsoever. If you're in, say, the 22% bracket, your long-term or qualified dividends can stop at the 15% bracket, which is obviously a lot more favorable. Now, again, the problem with mutual funds is you just don't have any control. And this isn't an individual investment advice, but this is why a lot of people that want to control their taxes choose to buy their own stock portfolio or work with a money manager that buys their own stock portfolio. Now, this comes with pros and cons. Obviously, there's a different level of complexity, and most stock portfolios that I've seen when I'm reviewing tax situations for folks, they tend to own less than 100. They could own 30 or 50, and that could bring higher volatility than a basket of mutual funds that typically own hundreds of stocks. But again, the purpose of this video is not investment advice, it is tax strategies. But in this case, if an investor that was concerned about controlling their taxes chose to go with stocks, they have complete control because they could instruct their money manager, or if they're a do-it-yourselfer, they can make the decision themselves to hold stocks past that 1-year mark so they can get those long-term capital gains, all things being equal, meaning it's worth holding for a year, right? They can also choose to buy domestic stocks and get those qualified dividends versus ordinary dividends because, again, it's not what you make, it's what you keep. Another thing to consider is interest is taxed at the same rate that high end, that short-term or ordinary dividends are at. So all things being equal, again, an interest-bearing item such as a bond paying 5% versus a stock paying a qualified dividend at 5% are going to be two different tax ratios. Obviously, they're going to be two different risks and volatility as well. So make appropriate decisions for yourself there. So that's kind of the concerns and some tips and tricks for mutual funds. Pay attention to turnover, pay attention to ordinary or qualified dividends, pay attention to how much of a percentage of, say, the last few years of the tax distribution of that fund was short-term versus long-term. There's some good resources on the web for that. Another thing I'll point out for those that are selling something that has a very large unrealized capital gain, such as real estate or really anything else, pay attention to how that works with your other investments. I actually did a tax scenario for a client yesterday that sold a rental investment property. When that happens, you have a depreciation recapture tax, meaning all of that depreciation over the years now gets recaptured on your tax return. And it really, in effect, is the difference between the purchase price and the sales price that books on your capital gains. We found out through doing a tax analysis that if they didn't make any other trades, they would pay zero tax on that $70,000 gain on that investment they sold, which was long term. However, they had an investment advisor that had a basket of stocks, and from time to time over the past years have traded those stocks. And I had to tell them that if you have more than a $6,000 gain on your investment portfolio, not only are you going to pay taxes on that $6,000 gain, but it's then going to make the $70,000 gain on the real estate also taxable. So that could be some very expensive trades. Obviously, they took this news back to their investment professional and said, hey, look, if there's a really big compelling reason to sell something because it's going to drop like a rock, obviously go for it. But if you can, try to minimize the trades you've got through the rest of the year because it will save me the capital gains on the real estate that I sold. So it's important to know how taxes act and react on your tax return. If you have any questions about your individual scenario, I definitely talk to people from time to time off of this channel, and you can reach out to me at team@independence-money.com or hit the website independence-money.com. Stay safe tax-wise out there. Prepare for some interesting and times in the economy, and y'all take care. Thank you.